Hi, I'm Amy McDermott with RE/MAX Professionals and the Jennifer Queen team, and today I'm going to be going over some key terms that I believe all home buyers should know. When you're in the process of buying a home, understanding these key terms in the real estate industry will just help you navigate the process more confidently. So here are some important terms for all home buyers. Appraisal. So appraisal is required in Manitoba when you put 20% more or down as a down payment on a house. And an appraisal is an assessment of the property's value conducted by a licensed appraisal. Closing costs. Most people, I think, know this term, but closing costs is various fees and expenses associated with the purchase of a property and that are due sort of at the end of the closing of the properties or possession. These are fees that generally you would pay to your lawyer. They do involve lawyer fees. They would include land transfer tax. Sometimes they include property taxes, things like that. So a down payment is the next term, and it's the initial payment made by a buyer, typically expressed as a percentage of the total purchase price. And here in Manitoba, a minimum of 5% is required. The deposit. So the deposit is made by the buyer to show their commitment to the purchase. It is typically held in the listing agent's trust until closing, and that sum does come off of your down payment. Typically, the more you provide as a deposit, the stronger your offer is to the seller. Another term I have is a fixed mortgage rate. I'm not going to dive too much into mortgages and that sort of thing. A fixed mortgage rate is a mortgage with an interest rate that remains consistent for the entire term of the loan. So there's fixed rate mortgages. You could also do variable, which would change. The variable rate would change, but fixed rate is something that stays consistent throughout the term. A home inspection. So a home inspection is a thorough examination of the property's condition, usually conducted, I shouldn't say usually, is preferred to be conducted by a professional inspector to identify any potential issues that may arise during your ownership or just the overall condition of the property. Listing agent. So listing agent is the real estate agent who represents the seller and lists the property for sale. A mortgage pre-approval. And this one is very important. You should not be looking at properties or offering on properties without a pre-approval in place. So a very key term here is a pre-approval, mortgage pre-approval. And the mortgage pre-approval is a process in which a lender or mortgage broker or bank reviews the buyer's or purchaser's financial information and provides just a preliminary commitment to lend a specific amount of money for a home purchase. The MLS service. MLS is a multiple listing service, and typically for short, we call it the MLS. So it's a database where real estate agents list properties for sale, making them accessible to other agents for potential buyers. Now, not all properties will be listed on the MLS. Sometimes listing agents decide to do an exclusive listing, which means it does not hit the MLS system, and it's just sort of like a pocket listing, they say, where agents will try to sell the property offline or off of the MLS. But a large percentage and the majority of properties will hit the MLS and will be listed and sold. An offer. An offer is a formal proposal to purchase a property, including proposed purchase price and other terms and conditions. So this is, typical your offer to purchase. This is where you would write your sort of wants in the property. So you purchase price, inclusions, exclusions, the conditions you want to write in your offer, and that would be like a financing condition, a home inspection condition, and anything else that you wanted to include within that offer. That is where you write it and you would sign it and initial it. Another mortgage term for you, another important one to know is the principal. So this is the principal on your mortgage, the amount of money borrowed for a mortgage, excluding the interest. So the principal is the amount of money that you borrowed for a mortgage, excluding that interest that you're paying. Underwriting. So underwriting is another mortgage term, and it's the process by which a lender evaluates the risk and determines whether to approve a mortgage application. We talked about the pre-approval before, and so once you have submitted an offer on a property and we have taken that offer and related documents, I would send it off to your mortgage broker. They would assess the situation, compile all the information that they needed to, and then they would send that information to the underwriter, who is the actual person that will be lending you the money. And they need to evaluate their risk, you as the purchaser, as well as the property. And so the underwriter is the ultimate decider there, and they obviously don't want to take on too much risk, and that's where you'd get the final decision on whether or not they're going to approve your mortgage application. So a conditional offer. Conditional offer is an offer that's been accepted by the seller, but the purchaser or the buyer has included conditions within their offer. So very common conditions that purchasers would write in there would be home inspection financing. Sometimes that's property disclosure statement, subject to the sale of my current or my existing property, just to name a few. But it just means that the seller has accepted one of those offers with a condition, and the purchasers are now working through those conditions and trying to satisfy those conditions. And they can be really any length of time. Typically, the home inspection, property disclosure statement, financing conditions are anywhere from 1 day to 7 to 10 sort of thing. It really depends. I would say the average amount of time for a conditional offer is about 5 to 7 days to kind of work through, home inspection or financing, something like that. Another one refers to condos. So the condo fee or condominium fee. So it's associated with condos, could be townhouse style, could be apartment style, could be single family attached, could be single family detached. It doesn't matter. And it just refers to the amount of money that you pay monthly for somebody to manage and look after the common elements and amenities of the community. The condo fees are usually split up into 2 different sections. A portion of that will go to the overall reserve fund, which is a sum of money that is kept for any repairs that might be required for the complex. And the other portion of the monthly condo fees would go towards, monthly expenses for the overall common areas and amenities. So if there's a pool, cleaning fees and that sort of thing, or the lawn service and the snow removal, and that's what those fees would go towards. Another one would be a survey. So sometimes you will get a survey or zoning, survey certificate or a zoning memorandum with the purchase of your property. They are very rare, to be quite honest. It's something that was a little more common several years ago, but we don't see them very frequently here. But just so you know, a survey of the property is essentially, you could also hire somebody to come out and do a survey of your property. So it's just a survey of your actual land. So you would say you're purchasing a single family detached house, you would hire somebody to come out and it would show your piece of property and where each structure is on that property and how far it is away from, your boundary line of your property. So say you wanted to build a garage, or say you wanted to build a fence around your property and have it just on the inside of your property, or your neighbor and you have discussed it and you'd like to put it right on the property line, then you might want to consider getting a survey. And so you know exactly where that middle line is. So it's not on your property, it's not on their property, it's sort of right in that middle line. And that survey would show you exactly where the plot of land is, and then structures on it would be. We're going to talk about counteroffers. So counteroffer is an offer made in response to a previous offer that rejects all or part of it while enabling negotiations to continue towards a mutually acceptable sales contract. We've already talked about the appraisal, which is conducted by a professional appraiser. The assessed value is a value placed on a home by a municipal assessor for the purpose of determining property taxes. So whatever that assessed value is, your taxes will be assessed based on that assessed value. value. We're going to talk about a conventional mortgage. So a conventional mortgage is one that is not insured or guaranteed by the federal government. So in this case, we'd be talking about CMHC. So a conventional mortgage is when you put 20% or more as your down payment. Anything less than 20%, you'd be paying a CMHC insurance on your mortgage. So homeowners insurance is a policy that protects you and the lender from fire or flood or liability, such as visitor's injury or damage to your personal property, a break-in or something like that. Easements, which is the legal right of access to use any property by individuals or groups for specific purposes. Easements may affect property values and are sometimes part of the title. So sometimes we see easements if the homeowner didn't get a survey done on the property, and by the off chance they accidentally built the fence on the city's property. So they built their fence, a foot onto the city's property. There would be an easement there, and the homeowner would be required to pay a small percentage back to the city for sort of use of their property. A lien is a claim or charge on the property for payment of a debt. And with a mortgage, the lender has the right to actually take the title of your property if you don't pay it. Possession date is the date as specified on your offer to purchase that the buyer can move into the property and when you take ownership of the property. Market value is the amount of money a potential buyer would pay you for your property. An appraisal value is an estimate of the current fair market value. So if you ask a realtor to come by your house, the one that you own, and you ask to give an appraisal or a market evaluation, this is the number that we would be providing. And it's a market evaluation in most cases. So we're just telling you sort of what has sold in the area. So what buyers are willing to pay in your area for a house similar to yours. So mortgage insurance, which is purchased by the buyer to protect the lender in the event of default. So typically for loans with less than 20% down, and it's available through the government agency, which I talked about is the CMHC. I'm going to talk a little bit about an open mortgage and then the opposite, which would obviously be a closed mortgage. So an open mortgage allows you to pay back your mortgage at any time. So you are allowed to throw sums of money down on your mortgage whenever you feel like it, or if you have extra cash lying around and you feel like making, an extra payment or 3 extra payments throughout the year, an open mortgage allows you to do that. So I guess you can assume that a closed mortgage doesn't allow you to do that. So if you've locked in at a 25-year amortization at a mortgage rate of $3,000 per month, that's what you'd be paying. $3,000 for X amount of years. Where an open mortgage, if it was the same case, you would be paying that same amount, your $3,000 per month, but say, you won the lottery and you had an extra $10,000 that you wanted to throw down on your mortgage, then you could do that with an open mortgage. Title insurance is an insurance policy that guarantees the accuracy of the title search and protects lenders and homeowners against unknown legal problems with their title. So when you go to your lawyer right before possession, your lawyer will in fact pull or do a title search to see if there's any sort of liens against the property or anything like that. This insurance would protect you as long as it wasn't on your title. So a title search is a historical view of the legal documents relating to the ownership of the property to determine if there have been any claims or encumbrances on the title of the property. Not everybody has access to put a lien on your title, but there are agencies and organizations that are allowed to do so. So one is obviously a mortgage, or your lender, I should say. Another one I've come across is government. So if you owe money to the government or you have outstanding dues to the government, they can put a lien against your property, and you are still allowed to sell your property, but with the funds that you might get back as a seller, you have to pay those liens out. Good. And those are just a few key terms that I thought would be helpful during a home buying purchase. And if you like what you're seeing and want to learn more about real estate, feel free to hit that like button and subscribe to our channel. Thanks for watching. I'm Amy McDermott with the Jennifer Queen team and RE/MAX Professionals.